All right, Mary Holm is in. Hi, Mary.
Hi, Jesse.
You a Rod Stewart fan?
Somewhat.
Okay, yeah.
Yeah.
Welcome. Nice to have you here.
Thank you.
And I said this to Catherine Ryan earlier. This email is a version of an email we get quite often.
Yes, it is.
And
yeah.
so I'll begin with that, and you can tell us what you've got to say on it. So
Sure.
from time to time, people email Mary via me, and this was one of those emails. It says, I'm over 65. I should say, by the way, Mary Holm, our personal finance expert, if you haven't heard Mary on the radio before. I'm over 65 and I have a few $1,000s, I presume that is, that I don't need right now. I might need it in a year or two. Until then, which is the best place to put it? In an interest-bearing account at 4.5%, or perhaps in a KiwiSaver account?
Yeah. And I should say you were promoting it as something that affects people over 65, but actually what I want to say affects everybody at any age. And there are two sort of key points here. One is, and I will answer where I think you should put the money, but one is that a really important question for anyone when they're working out where to invest their money is how long it's going to be before they spend it.
Yeah.
So that applies to younger ones saving for a first home, anyone saving for a car or whatever. And this listener has said he thinks he might be spending it in a couple of years, a year or two, he says. So the basic rules on when you're going to spend your money are, if it's, well, these are my rules, if it's within 3 years or so, then you want to just stick with something really low risk. And there are basically three options there. One is a bank account, a bank savings account, something like that. Another is bank term deposit. And the third is a cash fund, either in or out of KiwiSaver. So I'll get on to the cash funds in a minute. Everybody probably knows about bank accounts and term deposits. But the cash funds, I'll talk a bit more about that in a minute. But
all of those things too are things that go up but don't go down. Would that be fair to say?
Yes, it would. Yeah, cash funds could possibly occasionally go down just a little squidgen, but a proper cash fund shouldn't really. No. So, and that's why you're putting your short-term money in those, because you don't want, when you're going to go and spend it, to find the value's gone down. So you do quite defensive stuff there. Yeah. If you're going to be spending it in somewhere between about 3 years and about 10 years, the best place actually is in a bond fund, a fund that just holds bonds. And there are quite a few providers, KiwiSaver providers, who, and non-KiwiSaver managed fund people who have funds that invest in bonds. You can also, another option would be kind of just a middle risk KiwiSaver or non-KiwiSaver fund, like a balanced fund, which is sort of part shares, part bonds, and sometimes a few other investments in there as well. They're not as good as a bond fund, actually, because you're still in danger that when you're going to spend the money, the shares in it might have gone down, and that can sort of drag the whole of a balanced fund down. And so
a bad year in the share market would actually impact a balanced fund.
It would. Not as badly as a higher risk fund, but it will affect it, yes. And so bond funds are my favourite for people sort of between 3 and 10 years. And then if it's more than 10 years, if you can cope with the volatility, it's really a good idea to get into one of the higher risk funds, in or out of KiwiSaver. So that's the basic rules on when you're going to spend the money. So getting back to our listener, his choice, because he's going to be spending it in the next couple of years probably, a bank account or a term deposit. And I think it should be a bank term deposit, by the way. There are other finance companies and so on that offer term deposits, and they pay higher interest. But that higher interest is there for a reason. They're higher risk. Sometimes things go wrong with them. So I think if we're talking short-term money here, let's put it somewhere where it's pretty safe. Yeah. So stick with banks. And then the third choice is the cash fund. And okay, so in or out of KiwiSaver. Now this listener, he's over 65, so he could have it in KiwiSaver because they tend to be somewhat slightly lower fees than non-KiwiSaver funds, and they and he can get his money out whenever he wants to anyway. But if it's somebody else who's under 65 and they want to get the money out before they turn 65, obviously the best to go with a non-KiwiSaver fund. And what are they? Well, they basically invest in bank term deposits or similar investments to those. So if you're, as opposed to getting a single bank term deposit, you're in a fund that holds a whole lot of different term deposits that are maturing at different times and with different banks. They probably get a slightly better interest rate than you or I would get because they're big institutions, so they've got lots of money to invest. Yeah. You know, so they're coming in with $500,000. The bank's probably going to give them a better deal than we will get on our $1,000. But a couple of other points about them. The top tax rate, because you're in a fund, and they're all pie funds, the top tax rate is 28%. So for anyone who's in the 33% bracket or higher, 33 or 39% bracket, it's a really good idea to try and put your money into a fund because you're going to be taxed at a lower rate.
Why is that?
It's because their pies are called portfolio investment entities. All KiwiSaver funds are pies,
Right.
and
The government reduces the tax rate to make it more of an incentive for you to invest.
Years ago, 10 or 15 years ago, they brought these pies in, and I think they just felt New Zealanders were a bit behind on getting into managed funds because they hold a whole lot of different investments, keep the risk down. You know, when one or two things go wrong with a couple of the investments, it doesn't matter too much because you've got a whole lot of others. So we've got that lower tax rate there. And in a non-KiwiSaver version of a cash fund, which anyone can get into, you can withdraw the money within a few days, whereas in a term deposit, you're tying it up for the term of the deposit. So, if you were, say, in the housing market getting ready to buy and you're out there looking at houses, you might want to be in a cash fund because then you can get the money out fairly fast rather than tying it up for a year in a term deposit and then you find the house you want next week.
Yeah, that's great, Mary.
So that's an advantage of them. The trouble is at the moment, people are saying to me, and they've sent emails to you, and that, hey, in a term deposit I can get, as this man pointed out, the listener who emailed, he's looking at 4.5%. And if you go on Smart Investor and have a look at how the cash funds have been performing, it's lower than that. And so people are saying, blow this, I want, and I've had...
This term deposit's offering 5%, but this cash fund's only returned 2.5%.
That's right. That's the sort of difference there is. And I'm getting those letters and you're getting them. I mean, the variations on that theme. But be a bit careful because for a couple of reasons. One is that term deposit rates are quoted before tax. And so you've got a term deposit rate, let's say the bank is offering you 6%. If you're in the 33% tax bracket, which is kind of the higher to middle income people, your 6% becomes 4% by the time it's been taxed. And people don't realise that, they just concentrate. Our listener says 4.5% he can get at a bank. That's only 3% after a 33% tax on it.
Yeah.
So whereas when you're looking at the returns on a cash fund, they are given after fees and after tax. So we're not comparing apples with apples here. So just be aware of that you've got to take the tax off the term deposit rates. And the other thing is that when we're looking at returns on cash funds, we're looking backwards, like what they earned. In fact, on the Smart Investor, the latest ones are the year up to March this year. On term deposits, we're looking at what they're going to earn in the next year or whatever looking forward. And because interest rates have risen so dramatically, once again, we're not really comparing like with like.
That's such a good observation.
Yeah, well, when cash funds are their returns will inevitably go up. as the ones that are already in there mature and they roll over into higher.
Something would be very sorry to interrupt. Something would be very sick if cash funds weren't keeping up with term deposits, right?
Yes, it would.
Yeah.
In the long run, you've got to say what's going on here. You'd want to go with one with low fees, but by the time you allow for these tax differences, you should be doing better over the long term in a cash fund than in bank term deposits, and you've got access to the money. Pretty much, it takes a couple of days to get it out, but it's pretty quick. Have we got 1 minute to say how to find a cash fund?
Yeah, and let me just jump in here for a moment.
Sure.
Because I do not see a correct link 3 guesser.
Oh.
So that means it's hint dropping time, Mary.
Yes.
So a lot of you have correctly fixated on the titles of the songs. A lot of you have identified that all 3 songs have a verb in the title. And I guess my challenge to you is to work out what those 3 verbs have in common. And that's not easy, but whoever can work it out will win link 3 today. 2101 to text. 2101 to text. We're talking Breaking the Girl, Night Swimming, and Sailing by Rod Stewart.
Yeah,
Mary.
It's a tough one. I had to cheat, everybody. Ask Jessie. I couldn't do it. Yeah. How to find a cash fund. So there are quite a lot of providers. Your KiwiSaver provider might well offer one. Be warned, though, that quite a few funds that call themselves cash funds aren't pure cash funds. They have some short-term bonds and other types of investments in there, which is why they can sometimes, but your balance can sometimes go down, because short-term bonds don't get affected nearly as much as longer-term ones by changes in interest rates, but they can still get somewhat affected. So I reckon if we're talking this short-term money that people are going to be spending in the next few years, it's best to be in a cash fund that really only invests in basically term deposits and other very, very short-term instruments.
Your provider will be able to tell you.
Yes, yeah. And on the Smart Investor tool on Sorted, which I'm always sending people to because it's quite wonderful, and that you can look at KiwiSaver ones or non-KiwiSaver funds there. So first of all, go to the defensive funds, which are the lowest risk ones, and the cash funds are listed within that category. And look for the word cash in the name. There'll be X, such and such a provider's cash fund in there. But as I say, then have a look on Smart Investor at what their main investments are. They have a handy list of their 10 biggest investments, and see if they are in fact term deposits or if they've got a few short-term bonds in, which makes them a wee bit more likely. They're probably slightly higher interest rate on overall, but a little bit more likely to perhaps go down occasionally.
Okay.
Yeah.
Is that you?
Yes.
Okay.
Unless you've got any questions from anybody.
I do, actually.
Oh, okay. Yeah.
And by the way, link 3, not to do with water specifically, guys. It's not the aquatic theme. A lot of you thinking breaking waves and sailing and swimming. No, that's not it. 2101. Yes, somebody wanted to know if a term deposit, for example, is paying 2.5% to 3% net, and inflation is above 6%. How can you invest and not go backwards? It's a tough question.
You can't. They're quite right. I mean, and
better than putting it under your mattress, I suppose.
Well, it is. And any of these short-term investments for 0 to 3 years at the moment will be underperforming inflation.
But inflation is dropping.
Yes.
You wouldn't expect inflation to be at 6% for the next year.
Not really, no. I mean, I think the Reserve Bank's absolutely determined to get it down, and so I think inflation will drop. I mean, but it's a very good point. The trouble is, as you say, the options are putting it under the mattress, and that's, you're going to get zero interest there.
Yeah.
And it might burn, or it might get stolen, or it might get flooded, or, so, yeah. At the moment, we've got to just put up. If you want higher than inflation return, you're going to have to go into a very high-risk investment, and if it's short-term money, that's, a real worry, because right when you need it, it might be
quick one.
Very low. Yes.
I'm a 65 plus with a KiwiSaver account with 5,000 or 6,000 in it. I received my yearly statement recently and it had made a loss, but tax was deducted. this surprised me, and I'd very much appreciate your explanation.
Yes, well, there's on KiwiSaver funds that hold shares, there are situations where you do pay some tax even in lost shares.
It's tough, eh?
Yeah. On the other hand, you can get quite a good tax deal on them. And again, I mean, it's not that simple. We could go into KiwiSaver tax at some point, but it's kind of boring.
Yeah. Okay.
But
so to reassure
legitimate.
her, nothing has gone wrong there.
That's
She's not
right.
getting ripped off.
Yeah,
It can
but
happen.
just hang in there. That means you suggest you're in a middle to higher risk KiwiSaver fund, and it'll come right.
Mary Holm,
Yeah.
thanks so much.
Pleasure, Jesse.
Great to talk to you. Mary's previous interviews, podcasts, are on our website on the podcasts page.